All right, what's going on, everybody? Took me a minute. I had an issue with the restream, but I think we got it now. Just I don't know, it, just stuff. So what y'all got going on? That Tesla short worked out really good. I hope y'all had some of that. Just to get a little nibble, little bite of the apple. Got to get that cheddar. Oh, it was a Vast One update. That's what did it. Dirty dog. Version 25.9. Nobody cares. So this morning, Tesla was showing its shenanigans, and the call out that I gave was if it broke 436, we would run it to 426, and then we would reevaluate. 436 was this low. That's what I was basing it on. Basically, a breakdown of yesterday's range. That worked out pretty good. Once it got there, it pulled up. If we just run this back for a minute, it got down here. It pulled up to a 786. Tried to. Uh, they do this a lot, right? They try to run it up, and they don't know if they're going to succeed. They give it a shot, and if it works, great. They run it back. If it doesn't, then they kind of double down and keep going in the same direction, and that's what we had. It rolled over and down it went. Really nice leg down too. So now we would have updated to that level, and you can see this really clear two-bar reversal without getting into the 1, 2, 3, 6. That's leaving us in this situation right now. If you're using dynamic fib placement like I'm doing here, at some point in the day, you always have to bring it all the way down just to see where the real mid is. And another thing that I've done, if I'm sitting in a situation like this and it starts to just hang out here and digest in this zone, if it does it for too long, I'll go ahead and I'll update the drawing and bring it down anyways. It kind of sucks when you have to do that, but it's kind of trader's discretion at some point. If it's not updating or if price isn't continuing on, then you might as well just go ahead and move it into position. So that's why I was focused on it. Now, if we look at what kind of gave the heads up, this is Tesla on the daily chart. Let's get rid of my drawing. Yesterday, we had this really big outside bar. And this is one of the reasons that it was on my radar today. We closed here, we gapped up to here, and then we fell all day long. And that's an outside bar. You can see how it went outside of the range to the upside and it went outside of the range to the downside. And then there's almost no wick on either side. That's called a Marbozu. It's a very strong signal. If it was green, it'd be strong bullish. If it's red, it's strong bearish. So then in the overnight, it gapped up, right, to here. This is a beautiful opportunity when it does that, right? It's a gift. It's just a fabulous gift. If we had closed here and we gapped up like this, and then we start running, we break the previous day's high, that's telling you where we're headed, or excuse me, the previous day's mid, that tells you where you're headed. You aim for the high, and then you try to get a breakout and run it higher. Same thing here. We closed there. We gapped up higher than the mid. This one gave a little bit of a rope a dope, and away it went. Notice that that one didn't break the previous day's low. So this one, when it gapped up, I was concerned it was going to do this, but I was hoping it was going to do something like this, where it broke the previous day's high. So we gapped up. I gave that 436 as the breakdown target to start the trade. Said, let's see what it's going to do. Is it going to rope a dope and go that way? Or is it going to do one of these little fake outs and go the other way? Well, it went down instead of up. That's what we wanted. That's what we took. Now, as for the dynamic fib placement, that's just what we do on everything. Doesn't matter as Tesla or equities. As I've mentioned many times, I don't like to take options trades if we're already low. I don't like to short from the hole. I don't like to go long from the highs. But sometimes you just have to do it anyways. There's not a lot of opportunity to do it in a better way. I mean, look at the way it opened. Look at how strong and red that was all the way down. And when it got to that 426, we digested there through lunch just like we should. That was a lunchtime pause. Really good trade. Unfortunately, the textbooks don't lay things out like this. You have to kind of pick it up along the way. We call this like OCR type analysis, or you can use the hard right edge. So this right side of the chart is that hard right edge. You can just drag it back in time, pick a spot, and then start evaluating one candle at a time. What do we have in this little bit of a range? If tomorrow opens, which we know it will, right? Tomorrow always opens. If it opens below, what do we do? If it opens inside, what do we do? If it opens outside on the up end, what do we do? And then we just play it out, right? You can learn a lot from going back and evaluating that sort of price action, even on the intraday, although it's a lot more work on the intraday because there's so many more patterns. But start out on the daily, especially if you're swing trading, and just take things one candle at a time, OCR type of analysis. Even in this situation, you had the stop triggers to where, you have to evaluate if people were getting short this day, where did they put their stops? Above the high. If people were getting short that day, where did they put their stops? Above the high. Same thing, short that day, where did they put their stops? Above the high. Then we get this breakout. Price triggers all those stops. If they were short traders, their stops are buy orders to close their short trade. So that lands in a pool of buying that adds to the buying. It takes us up to the next level. We hit those stops. Those are a bunch of buy orders. It's more fuel. It takes us up to the next level, on and on and on. Right. And then you can evaluate that price action inside the trading day as it's happening, watching the tape, the order flow, just watching it all come through. That baboon was probably my great 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 granddaddy. Nobody saw me kiss my cousin. I thought that Tesla trade went really good. It's not an unusual trade. It was just a nice gift. It was a nice follow through, right? So we got to take them when we can get them. Big picture, I don't know how much this is going to affect the overall market structure and sentiment. It is a megaphone pattern, sort of, maybe. A megaphone would be better if it looked like that, nice and clear. And that's not exactly what we have, but they're not always pretty. But anyways, a Marbozu is a really good candle to study. It really is. It's worth the effort of going in and kind of learning just a few of the bigger patterns. Oh, So I know patterns are really popular. The head and shoulders, the wedge, the bull flag and bear flag. All of those patterns are what most people tend to focus on. But the individual candles themselves, or a 2 bar pattern, maybe a 3 bar pattern, they're a lot easier to learn. Granted, there's probably a lot to digest there, but they're one at a time. And then you can kind of diversify yourself a little bit, pick one or two candles or candle signals that are longs or continuations, shorts, which are also continuations, and then reversal patterns. And if you diversify like that, you don't feel so overwhelmed like you're trying to learn the entire cyclopedia of all of the candles all at once. Pick something like a hammer or a doji, a marbozu. Those are really easy to see. Most charting platforms, if they do any sort of candle analysis, they'll do those three, and they're easy to color code. Even Thinkorswim will color code your doji for you. Maybe not the marbozu so much, but it'll definitely do the dojis. There is a lot that can be identified within the candle structure. I know it just seems simple: open, high, low, close, but really a lot can be said about that. And if you use the candle that I use, you'll notice some of my green candles or blue candles, some are hollow and some are solid. And with the red ones, some are hollow and some are solid. And that's because these are called trend candles, depending on what platform you use, anyways, that's what they'll call them. And the candles are telling me, by the way they're hollow or not hollow, where price opened and where it closed. So at a glance, I get a lot more information than just seeing a red candle or a green candle. The candles that I'm using, if it's blue or green and it's hollow, that means it closed at the high and it closed above the previous day's close, both. But if it's solid like this, that means it closed lower than it opened, but it still closed higher than the previous day's close. That might seem a little complicated to you at first if you've never come across this before, but if you use it for a little while, it just becomes really intuitive and comfortable. So you don't even think about it. It's just a natural logic. Until you get there, you can always just write a little cheat sheet, take a picture of it, annotate it, make it all nice and pretty, put lipstick on a pig. The other one, the red one, when it's solid, that's a normal red candle. It means that it closed lower than it opened and it closed lower than the previous day. Simple, easy. It's what everybody thinks of a red candle. But when it's hollow, it says that it closed higher than it opened, but it still closed lower than the previous day's low. So it's hollow. Again, it might seem complicated, but only until you do it for a while. And then it'll just be really simple, easy. And so a hollow candle just tells us where price closed. Did it close higher than the previous day's close? Did it close higher than where we opened? Right? That's all it's telling us. No momentum, no trend, no inertia, just how did this close? Is it above the open and is it above or below yesterday's close? I don't know why they call them trend candles because they have no bearing on trend whatsoever. Here's Thinkorswim. And if we go into the gear icon and go to the appearance section, we can see that it's called candle trend. It has no bearing on trend, but my suspicion is that you can read the trend, right? Like I guess that's why they came up with the name. That's my best guess. They needed to call it something. They called it candle trend, but the difference between that and a regular candle is a regular candle will only focus on what price did today, I believe, and it will have no impact whatsoever on where the close of that candle is in relation to the previous bar's close. But now that I have that on, I feel like I'm missing information. There's that is right. The trend is your friend. But these all solid candles make me feel like I don't have all the information. Yeah, Heiken is really great if you're dealing with like a choppy product or something that has really big wicks all over the place in their regular price. Turn that on and it cleans up the chart a lot. In my mind, while I was saying that, I was thinking about the 10-year. The 10-year is just such an ugly chart, and you can put Heiken on it, and it kind of cleans it up. The See how ugly that chart is? This is just disgusting. Little dashes and dots all over the place, big stretched wicks. If we were to turn on Heiken, it would just really clean things up nicely. The problem for me with Heiken is that it's not real candles. The open and the close are not real. The distance that it showed price moved is not right. So the high and the low are not accurate. You're not looking at a candle. You're looking at something that looks like a candle. You're not looking at real price action. And man, I don't want something that's going to lie to me. I read price. So if it says we went to 4.12, I'm expecting that it really went to 4.12. Don't lie to me and say that it did when it really didn't, right? Because then I'm going to get mad when my time and sales don't match up with the price action. And I'm thinking the broker's broken and something is wrong. And ah, but it will clean up an ugly chart. That is for sure. So it is a really good indicator, but it is really bad for price, right? If you're a price action trader, I don't recommend it. Or at least just do it on another chart, right? Have a real chart on one side and then have your Heiken chart on the other side so that you can compare the two. I have to go back and look because I do not remember what was on the list to talk about today, other than that Intel trade. I had the plumbers here ripping my yard up. It's been a really hectic morning, and I'm out there on my phone trading in the yard, and had a lot of fun. I don't recommend it. All right, so one of the topic requests is losing and how it is having an effect on you. You know, I had a client for a long time who was reading the price action completely backwards. I didn't know this, but you can have dyslexia in price reading. I was totally surprised when I found out what the problem was. But, anyways, he was losing constantly, and I mean every single trade. And I told him that's statistically impossible. Like even on accident, you're going to win one once in a while. You can't lose every single trade. It's impossible. What are you doing? And we finally figured out that he was just dyslexic. He was reading it the wrong way. And we got all that straightened out and it was fine. But he wasn't taking pictures of his trades. So I couldn't see what he was doing. He had no examples of the problem. He just was really frustrated and he was telling me how he was losing all the time. And it broke his confidence. He was to the point where he's like, I don't know what to do. When it got to yesterday's high, I tried to buy it, that didn't work. When it got there again, I tried to sell it, that didn't work. Like, he tried everything you could try. But if you didn't catch that, there's some trouble with what he was trying to do, right? If a market got to the previous day's high and it tried to break out and it failed and it came back in and then it tried it again, what do you think it's going to do the second time? Right? It's probably going to fail again and come back down. So, you know, changing your tactic because you went long and that didn't work. So next time you're going to go short and then that didn't work. You could very likely just be playing on the failure that the market is already playing on. And then you're just locking in your losses and you're not sticking to a system. You're almost guessing at that point and tossing quarters in the air and hoping it gives you an answer. But there are some things that you can do to help with this situation. One, if you are losing a lot of times, the very first thing that you can do to improve your win rate is just to lower your profit target. I know that sounds very simplistic, but it works, right? Because math is math. So if you are trying to get 20 points with a 2 point stop, then don't do that, right? Lower it, cut it in half and see if you can win more often. And if that doesn't get you to the desired win rate that you're looking for, cut it in half again. If you lower your profit target enough, you'll start to win more often. Unfortunately, that's not sustainable as a tradable system, as a strategy, right? Because we can't risk 15 to make two and then, be excited about a 90% win rate. Even a 97% win rate with those numbers would still blow you up because winning is not the goal. Making money and keeping it, that's the goal. I have a win rate less than 70%. Month after month, that's my average, less than 70. And there's some months I can get into the high 60s, but generally it's in the low 60s most of the time. And yet I'm completely happy with that. I'm fine. But if you was to interview me on the street, right, just some Joe Schmo, and you say, "Hey, you think it's acceptable to lose 35% of the time in your trading?" Anybody? Bueller? 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 Sound good losing 35% of the time? Most people are going to say, "Heck no, that's losing way too much. You can't lose 35% of the time. That's not sustainable." It is for me. More than enough. I am happy with it. So winning all the time isn't the goal. But if you do want to win more frequently, especially when you're trying to figure out what's wrong with your system or to make an adjustment to your system, dial back your target. You will win more often. It's just not sustainable, right? So the next thing that you can do is at the end of all of your trades, and you can do them one at a time at the end of every single trade, or you can just do it at the end of the day after all of your trades. Go back and evaluate which ones were good ones and which one were bad ones. A little tip, just because it won or made you money does not mean it was a good trade. I have taken really horrible trades that made me money, and I have taken really good trades that lost money. It doesn't make sense, but that's the way it is. What makes it bad? What makes it good? Did it have your trade signal? There's a little hint in that. Do you even have a trade signal? Did it follow the rules of the trade as it is supposed to happen? Do you even know what your trade looks like? Could you draw it out with a pen and paper? Could you articulate it in paragraphs and explain what the trade looks like in detail? If you can't draw it, find it, point it out in the past, articulate it, what the hell are you trading? How do you know what it looks like if you can't tell me what it looks like? So if your trades are losing, which trades are good and which ones are bad? Also consider high risk zones. I don't have the picture. I went looking for it earlier and I can't find it. I know I've got an example of it on my website somewhere, but within the trading day, just a 24-hour trading day, you've got these ranges, right? So you got like the kill zone at 2 a.m. and that ends at 4. That's its own little zone. You've got this time between 8 and 10 that I consider a high risk, high danger zone. And then of course you've got the lunch range between like 11:30 and 1. and you've got power hour that goes into the end of the day. And each one of these are their own little zones. A high risk zone for me is 8 to 10 and 3 to 4. Those are really big high risk zones. I don't trade in those. Very, very rarely I might put one on because I'm human like everybody else and I break my own rules eventually. But for the most part, I just don't even bother looking for a trade in those time frames. Why? They're high risk. They're danger. If I trade in that time frame, I know I am going to need a larger stop more often than not. And yet my win rate really doesn't improve in there. The only thing that happens is that when I do lose, the losses are bigger, but I don't have a higher success rate. So I don't trade in those zones. I just leave them alone completely. If you're having trouble getting on the right side of a trade, go back and consider why you even got into the trade in the first place. I see a lot of traders with that sort of a statement who will trade between 9:30 and 10:30 and they'll trade in something that looks like this. And then they'll wonder why they just got their butt handed to them. I don't know what happened. Everything I tried failed. What the heck were you trading in here? That's a 10-point range. Are you telling me that you're so good that you're going to hit tops and bottoms and get all 10 points in this 10-point range? Because you're a beast if you can. I can't do that. I can do it on accident sometimes, get tops and bottoms, and then I brag about it for like 3 days. But more often than not, if it's a 10-point range, I can expect to get 3 or 4, maybe 6 if I'm on my game. That's it, right? So look at the trades that you're taking and measure their quality. Now, you're the judge. So you get to determine what was good quality and what was bad quality. But if you don't have a metric system at all to even define that quality, well, then now you've got a place to start. Go back in the past, find an example of the trade that you tried to take, and then measure it against the trade that you actually did take. Do they match in any way, shape, or form? 'Cause if they don't, what the heck were you trading? So journal your trades and then break down your trades. Um, we had a talk a long time ago about apex trading and prop firm trading and whether or not it was a good thing. And one of the things that I determined out of all of that is that it kind of is a good thing. Once you get a paid prop account, at some point, they're going to deny you a payment and they're going to want you to validate a trade that you took because sooner or later, you're going to get an outsized win, big profits. And they don't want crazy big outsized wins. It looks like you're gambling. And when that happens, all you have to do is prove that the trade that you took is within the parameters of the trades that you've been taking, and you just happen to have a good, lucky, big blowout trade. If you can do that, you get your profits. If you can't do that, they'll not pay you for it. They'll say, nope, that was a gamble trade, and we don't pay gamble trades. So you want to be able to articulate what's your trade strategy? What exactly does your trade style encompass? And when you do take a trade, what are the rules and the parameters of that trade? Because if you can't do that, sooner or later, you're not going to get paid. They're going to deny you a trade and you won't have any way to fight them because you won't be able to explain what your trade is. And I liked that because I thought, well, this is going to force people to really knuckle down and describe to at least to themselves what their trade is. So if you're having this issue, because I copied the words, the request was keep losing money and it's having a huge impact. I can't seem to get on the right side of a trade. And believe me, I get it. So hopefully the things that we've talked about today answers some of this how do we fix it problem, right? Having a clear, articulated trading plan and then evaluating the trades you took to see that it matches that trading plan. So, for some of all of this, it often ties in with how big of a stop should I use? That's a really tricky question because the stop ties in with your skill at reading price action and going with the flow. If you can time your trade the way surfers pop up on a surfboard, being very nimble and responding to the wave of the flow of orders that are coming in, you can use a relatively tight stop. But if you can't do that whatsoever, you're going to need a wider stop. Otherwise, you're very likely just going to get wicked out. So, how big your stop should be is very well connected to your ability to read price and get in with the flow. Otherwise, it won't matter that you're right. Your stop will be so small that it'll stop you out and then go in the direction you thought it was going to go without you even being in it. And that sucks. But how do you know? That's where paper comes in. Hey, I hope you have a good weekend, buddy. Always appreciate you stopping in. Yes, sir. This is one of the times where paper really helps, right? You go to paper and you set yourself a stop and you try to trade. Now, be mindful of those no go zones that I was mentioning earlier. If you're trading in a high volatility environment, you're going to need a bigger stop. That's the rules, right? That's the way it works. And every day is a different day. Between 8 and 10, we can have these mornings that are really slow, really boring, no violence comes in, and the market stays in this tiny little range for 45 minutes, and then it finally moves. And that can throw you off. That one day that you trade it at 9:35 and we're just not doing anything and you got no volatility. But most of the time you're going to get a move in that range. You know, or you get some trash that looks like this. So you need multiple examples, multiple days, multiple approaches. Go to paper, set yourself a stop, keep track of the level of volatility within that trading day, and see how well you do. Now, a lot of people will use different tactics or tools to measure volatility, but one of the easiest things to use is just price action. Look at the dome. So here's the ES, and I don't have full book, so we're only going to see one red and one green, but that's okay. See how it's not moving all that much? And when it does move, it's really just moving one tick. I mean, that's nice. It's easy. It's laid back. There's no violence here. Now take that over to the NASDAQ. This afternoon is a laid back, quiet day. We're not really, well, there we go. We went from 7 to 4 back to 7. Now we're at 10, right? So when it moves, it's moving in points, not even in ticks. It's just jumping one point at a time. You would never know that it's one of the most liquid futures products, right? Especially the MNQ, which is the most liquid. This thing gets almost twice the amount of average daily trading volume than the ES or the MES. Some days it gets more than both of those combined. Can you imagine? That usually surprises people when I tell them that because they think that this violence is because it's not liquid enough. Well, that's not true. It has twice the liquidity as the ES. So it's janky, it's violent, it's jumping up and down, and this is a calm part of the day. If we were looking at it between 9:30 and 10, it would be a lot more violent than this. If you were attempting to trade this, you would need a much bigger stop. So that's what I'm saying when it comes to the stop size, you have to evaluate what market conditions you're in. If you don't do very well with trying to gauge price, especially with the dome, try something else. there is an indicator called the ATR indicator. This one's really popular for evaluating volatility. Now, by default, it is set to 14, so it's looking back over the last 14 candles, but we don't want to have to do any math. Set it to 1. Now, what this is going to tell you is how much movement did the last candle get? And we can compare that candle to the candle before it, and then we can compare that one to the candle before it, and see how when we were at the open, the movement from one candle to the next was really violent. We were getting very large moves. And then we had this event at 1 o'clock today. What a move! Biggest move of the day, right? And then it got high here, but otherwise it's kind of trying to get back down to these smaller candles. So we can use this to gauge where are we right now? Are we looking at the lowest volatility of the day, or are we looking at the highest volatility of the day? That way you got a better understanding of what size of a stop am I going to need to use. If this is really high, you're probably going to need to use a much bigger stop. Or you're just going to have to be very good at reading price action and the tape and order flow. And this is a self packaged product. So you don't have to have some book that says, well, the ES or the NQ has this much volatility a day, blah, blah, blah. You can just open it up and look back and say, what's the average? Below 15 is good, right? I can see that just at a glance. Below 15 is good. Above 20 gets us into some violence. And if we're above 50, just get under your desk and hug your knees and rock back and forth. Yeah. Yep. That sounds about right. Right? So a simple little indicator ATR, just set it to 1. If you like having things on the candles, you could put the Bollinger Band on there and set it to 1 or set it to 1.5. You could try the Keltner channels and cut that number by 50%. By default, I can't remember what Keltners are at the moment. They are 1.5, so you could cut it down to at least a 1 and see how much that helps, right? Because we're just trying to define how violent is price right now, and is it escaping the boundaries of what we would consider to be acceptable range, right? It's not going to be perfect, but if you're stuck fighting volatility or find yourself trading in a high volatility environment, maybe these will help you better visualize those risks. The problem with this question that is going to be hard to solve is after you've had a couple of losses and you have lost your confidence, that's a really big deal and it's going to be hard to get that back. It's not like we can just go to the store and, buy another bag of confidence. And that's the trouble, right? Like where do you get that again? And you're going to have to build it. It's like losing trust, right? Once you lose trust or somebody loses trust in you, getting it back is so difficult. And that's why it's such an important commodity, right? Yeah, I don't know if avoid is the right word. I don't even seek out an opportunity to trade between 8 and 10. I'm still here, I'm watching, but most of the time I don't even look for a trade, right? But if it's so obvious that it's slapping me in the face, I might trade it anyways. Um, in 2025, I've had less than 5 trades between 8 and 10 a.m. for the whole year. So it's not necessarily that I go out of my way to not trade in that time frame. I just don't even look for a trade because I don't expect to find anything. You know what I mean? And I know me. If I go looking, I'll begin to try to convince myself that something is there. oh, it's not that bad. Volatility's okay. You should go ahead and trade it anyways. We're already here. It looks pretty good. There's your setup. Why not trade it? I know me, right? So I don't even attempt to find it. That's why a lot of times you guys don't see me post ES and Nasdaq charts in that time frame. Or if I do, it's only just as like a update. That it's not like signals for entries or anything. 3 to 4 is the other go zone. We got MOC orders, um, window dressing. There's all kinds of things, removal of lock limits that make the time period between 3 and 4 just a really dangerous time to trade. And I thought there was a place like Edgeful or maybe some other company that had statistics on how often markets reversed course in that last hour of the day. And the reversal statistics off the top of my head, because I know I don't have the accurate number, but it was a lot. It was a lot more than you would have thought, right? So established trends get broken, ranges get violated, and markets make weird moves in that last hour. And sure, if you're ready for it, it's all good. But if you're looking to play the established pattern of the day, it's going to leave you disappointed because a lot of times that's when we lose the established pattern of the day. So I try to get out of trades that I'm in sometime after 3. It's not like I'm looking at the clock and the bell rings 3 and I get out of my trades, but I won't add to trades that I'm already in. I will find exits after 3 and I won't look for new ones after 3. I'm done. Unless we're talking swing trades, right? Because that's a really good time to go shopping. Swing trades are completely different for the 3 to 4 time frame. We're talking intraday trades. I don't want to go hunting for another one after 3 o'clock. For swing trades, any time after 2 is a really good time to go shopping. It's a fantastic opportunity to look for a new trade. I love it. I wouldn't have it any other way. We need to get the watch list down at the bottom of the screen. Mhm. Banks were having a hard time of it this week, huh? City and all those guys, and they're going to have earnings coming soon too. So as a part of the whole candle thing, OCR style analysis, all of that in the afternoon, anytime after say 2 o'clock, I like to start shopping around for opportunities. Now again, there's these danger zones. The thing about swing trades is the zone is different. When it comes to swing trades, the zone that I'm looking at is what sort of economic backdrop are we in? Do we have big picture stuff like FOMC this week, QRA, non-farm payroll, something like that? Because that'll be a dangerous zone. It won't be some particular time of the day, but instead some particular date of the week or some upcoming day on the monthly time frame. Those zones are areas where I won't add to positions or I won't look for new trades. Um, Depending on how the S&P and the Nasdaq are behaving, I won't go shopping for new equity trades. Try not to fight the system, right? So JP Morgan, we had this really nice drop, and I'm watching it right now for a lower high. I didn't get to play the reversal yesterday. I don't know that I would have, but I didn't get a chance either way. If we was to go back and analyze this, let's do it on Thinkorswim. I have a better drawing tool. I don't get to say that very often. Usually, TradingView's got the better tool, but I've got two quad lines on Thinkorswim. So yesterday had the better opportunity. If you look at where the mid was, that was a really bad drawing. We closed below the mid after a nice little rally off the lows. So that was a more, um, not more better. That was just a better signal for a long, at least an attempt of a long. But if we look at the day before, it was another signal that said, don't go long yet. We closed under the half. The This long wick and this long wick combined shows that we weren't done yet, right? It just kept failing. I think this one too. Did it close under the half? Yeah, that one too. This one also didn't. I thought it was going to measure better than that, but it didn't. So this green day, I wouldn't have tried to trade this. I wouldn't have tried to trade this because it still closed under the half. You want one of these rally days that closes like this. And of course, that one lost. It didn't actually give you a good signal, but near the end of the day, you want to evaluate where price is and then get the consideration of, well, do I have a trade for tomorrow? And then put that in the bigger picture of, well, what is this sector doing? What is this industry doing? And how does that match the backdrop of the S&P and the NASDAQ? If you don't mind trading in the mornings like we did with Tesla today, then that's fine. You don't have to do this approach. But the afternoons can offer some really good opportunities. And the good thing is if there's nothing there, it's just nothing there. And you just move on to the next one. So like American Airlines, there was an inside day breakout. This one closed better than its 50%. So near the end of that day, you could have been considering a long. The next day, if you didn't get that long, the next day it opened up, faded to the downside, and it never even got back to the close. So there was a little bit of a rope a dope, and then it tried to run, and you had an inside day breakout. That was a long trade. The same thing can be said over and over again, right? Chewy. Let's go look at Chewy. That might be a good one too. Yeah, that's a good example of just what I was saying. It closed in the upper part of the day. I like those. If I'm going to try to trade a reversal, that's exactly what I want to see. That's a good start, right? But then we have to go and we got to look at a couple of other things. Is there any other reason to think that this wouldn't have been a good long? And I can even argue now that the long isn't wrong yet, right? We broke this lower trend line, so that might make you think that you're going the wrong way, but maybe not yet, right? So it came down, it bounced on the lower trend line, it rallied up, and it closed in the upper 50%, even in the upper 25%, probably. So all of that says that's a really good deal. And without today's bar, yesterday's bar looked like a higher low, right? I mean that's fair. All of that is fair. That's a good, honest entry right there. But is there anything that would make me hesitate and say, I don't know, this probably would be a high risk trade? Well, when we zoom out, we are inside of this really big bar. right? This really big bar. And the midpoint is basically $39. And on the week, we broke last week's midpoint. Now, I don't know the relation to that of where we closed yesterday. Let's get that. Let's mark yesterday's close right there. Now we'll go back to the weekly. All right. So yesterday we were still above the midpoint of last week. So that's another good reason to go long, to give it a shot. We're above last week's mid. We bounced on that trend line and we started to rally. We closed in the upper 25%. All of those are really good reasons. What about the sector that it's in or the industry that it belongs to? We haven't had any news in this thing since September 26th, so that isn't helping. But the last time they did talk, they talked about the short interest on Chewy. It doesn't have a lot of short position. All it's really pointing out is that the short position has increased a little, which is fine. I mean, thanks for the heads up, but it's not like a massive amount of short interest, just a little bit. 1.5 days to cover. That's not really that big. What category do we put Chewy in? Right? Let's turn on the phase score, get some information on this thing. Specialty retail, consumer discretionary. So if growth is doing good, then Chewy's going to do good. And if value is doing better, then Chewy's going to suffer. In relation to Chewy, you would probably want something else that's growth, right? The Mag 7 is growth. Oops, go back. And that's not really helpful. Yesterday was red, today was red. But yesterday, the Mag 7 didn't rally back the way that Chewy did. So, not a lot of comparable analysis here. That's not helpful. What else we got? Specialty retail. What's the specialty retail ETF? It's always that four-letter one that I can never remember. No, is it XRT? That don't sound right. Sure is XRT. I thought it was the four-letter one, but it's not. XRT. That's specialty retail, and that doesn't look anything like Chewy either. So a little bit of a heads up there, right? With this, Chewy's not moving in relation to its sector group. That it's not moving in the same way. It's kind of doing its own thing. The only other thing that I see as a warning on Chewy, and none of them would have stopped me from taking the same trade that you took, is this really big gap down on earnings, and the gap isn't closed yet. But that's more of an argument for a long than a short, because we're still expecting to get up to $42 and close that gap. I don't see anything wrong with the long that you took. I would have taken the same long, other than the uncertainty of the environment that we're in. That, it's a bad idea to hunt for longs in an environment where we're topping out and the market's all over the place and we got government shutdown uncertainty and blah 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 blah. Looking for new trades right now is a bad idea. Other than that, that's a really good signal. I would trade that signal. There's nothing wrong with it. And you don't know that you're wrong yet. Yesterday is what we thought was the higher low. It could end up being that this is the higher low because you're still not down here below 37 giving a lower low yet, and this is just a continuous move. We haven't set our higher lower high yet, or higher high. We don't have a an answer yet, right? So as far as you know, you're not wrong. Yeah, I mean it's certainly possible. Let's bring up a chart that has some indicators on it. All right, so we are above the 200 period moving average. Now, when we give it some depth like this, we can see that there was the move down, the base for over a year, and that it's now trying to turn and go back up. And if you need any reminder for anybody, the newer guys, right? Not we've all talked about this before, but anybody new here, Carvana is the example of what we're trying to accomplish with this Chewy trade, right? It had the steep and deep drop, a large base, higher in space. And if you look at that 200 period, there was a time where we were crossing above and below it for a long time. And then we started to curve and turn it higher. But the only way that you get this curve higher is if you outrun it a lot. You have to stay above that 200 by a considerable amount and you force the 200 to curve higher. If you're kind of hanging out near the 200, it's only going to slowly start to rise, just a little gentle. And we want it to be a lot steeper, right? We want the 200 to look like this, really steep, sharp curves. So we got to get way ahead of that 200. And if you look, we spent a lot of time crossing back and forth before we really started to get ahead and get out of it. So now back to Chewy. We've gotten above it. We're holding above it more now. We're getting that retest, but it's got a lot of work to do, right? And it is a really violent stock. So there has to be an expectation that we can come back down just like we did here and here and here and break that 200, maybe even rest on the 300 or the 400. I think that's the four, really. Typically, I don't use the four except for weeklies, but you know, whatever. Yeah, it's the 400 week. That we're going to cross above and below that 200 for a while and that it's just a process. And this isn't broken, right? We don't know yet if it's going to end up giving you a lower high or lower low. And even then, if it breaks that low, it's still not a guarantee of anything yet. That was a fair entry, all things considered. No argument about it. It was fair. There is some warnings, right? That we were in the middle of a range and that when you try to get in before a breakout like this, that it could be Grimes pre-consolidation breakout, or it could have just been the beginning of the rollover. So I don't think you did anything wrong. As long as you were prepared to manage the trade so that the loss doesn't get out of hand. Remember, the goal isn't to not lose because that's impossible, right? We're going to lose. The goal isn't to not lose. It's just to recognize that it's not doing what we wanted and shut it down as fast as we can and move on to another trade. But I'm looking at this and the only thing I kept thinking is, hell, I would have traded that. You know, you you took a trade that I would take, so I think it's a bad one at all. Yeah, that's almost well, no, I'm still looking for a good example of a megaphone. I said megaphone earlier and it was not. Now my eyes are like, there's one. No, it ain't. So what you had here is yeah, end of day swing. First thing I like to start with is how's it closing? Ooh, it closed really close to that 50, but above the 50. That's a good start. It also looked like it was trying to recover from the trend line break, which it did. It got back above by the end of the day. So there was that too. There is some warnings, right? A lot of these outsized bars, big wicks on each side. That's so much indecision, and there's no clear leadership. That on this chart time frame, it is a real big battle between buyers and sellers at the moment with no dominant leadership. I really don't like those trades where there's no dominant leadership because it leaves me wondering which side I should be supporting. But let's just step out a little higher and see what else we got. See, now I like that. That would have been a nice reversal yesterday, right? Off of the midpoint here. Oh no, it's under the mid. Well, it looked like for a moment we were bouncing on the mid. And maybe we was, right? Where was the bounce yesterday? We get rid of this, get rid of that, mark yesterday's close, and then put it on a weekly to see where we closed at. Yeah, no, we were still below the half. All right, but what about the really big bar? Because this big bar is your control bar. Now, see, there you go. We bounced on the mid of this control bar, and we were on our way back up yesterday. Yeah, I knew before we even got back over here, we bounced on that. So a big gap down, and then we fell even lower. We bounced on that, and we come back up. There's this concept that they talk about, bounce into resistance. I think UNH has a good example of this. Man, if you want to study how things fall, UNH is a really good example of how things fall. So with UNH, they had extreme drops, bounced into resistance, another extreme drop, violent run to the upside as if it was really going to get anywhere, but it didn't. All it did is rallied into resistance, down it went, rally into resistance, down it went. You kind of get the idea. So when we get those rallies and people are thinking it's like a dead cat bounce or we're it was just a 786 pullback and we're headed back up and then it just keeps going lower. They were faked out with these bounces into resistance. Not that I necessarily have a solution to the problem either, just that at least if you know that those exist, then you can try to spot signals that are warning you that that's what you're getting. Also, Rocket is connected directly to bonds. If you ever trade this thing, you want to see what's going on in bonds. Rocket also ties with Redfin and Open. So, how they're doing is something you want to pay particular attention to. And we could argue at this point that we are still above that midpoint of the control bar. Not by very much, that's true, but we are above it. Now that we're on the intraday, look at how it bounced off that level yesterday and tried to rally. And we ended up getting the higher low and the higher high. The problem is for a full set, you need two higher highs and two higher lows. This would have been a lower low from that one, or a lower high from that one. And that was your first higher high. This is the first reversal off of that. And so there's your higher low. So we don't have a full set on the reversal. And this is a little 15-minute on the intraday too. It's not like we would want to use this. Then for today, the breakdown of it, an attempted TRB, and we're stalling out. That's troublesome. If this was a good TRB, it would have made it back to the highs. The fact that it didn't and it's giving another lower high is not good. But you had a relatively good argument for taking that. Some warning signs really is how close it was to the midpoint. That would have been one flag that got my attention. There's reciprocation. This one is a little sneaky. I don't know how many would have caught it, but look at the distance we got on the breakout of this bar because this is our daily control bar. The other marker that I have is from the weekly. This is the boss. It's the one in control. Before today, God, that's a lot of stuff in it. Before today, we had this measurement, and then yesterday we had that measurement. That's my reciprocation. That we got the same amount on the upside that we did on the downside, which really just tries to account for why we came back up. We bounced on the control bar's midpoint. We rallied back up inside this big control bar from the daily, and it just matched a reciprocation pattern from one side to the other. But we wouldn't see that as bullish. It was more of just a bounce on support, rally up into resistance before rolling over and coming back down to recheck support. We did the same thing back here. Rallied up here, fake breakout, fast failure, came back down, bounced on support, rallied into resistance, came back down, bounced on support, rallied into resistance. Only that time they had the strength to gap it in the overnight and try to run it. It was a solid attempt. The warning signs, I don't know if they would have been enough to keep somebody out because you got to take some risk or you're just never going to get a trade at all, right? If everything has to be perfect, you're never going to get in. So this was a good attempt. And as long as you was prepared for the trade not to work and you had a game plan for an exit, then why not, right? Especially if the options were decent, or if you did it with stock, because you could really defend this trade with it's cheap enough to get the stock and then defend it with options. And it has plenty of time left, right? Like plenty of move. I don't know how long your swing is either. Looking at it from this perspective, we're below that midpoint, but that doesn't mean anything yet, right? Because we haven't closed, we don't have our low yet. Low, higher low, question mark. So for all we know, this is going to turn here and it's going to go back up, and that's going to end up being the next higher low, right? And so until we know, we just don't know what that's going to be. But we do know that we've had the higher highs and we've had the higher lows, and we're just getting a deeper pullback here than we've had since April. That was a really big pullback too, and it still worked out. There is a logic. I don't remember what the textbooks call this, but this big control bar right here, it was a red bar, and we went higher when we finally got out of it. And then you have this really big control bar, and it's green instead of red. Now, there's a difference between these two other than just the colors. Obviously, the color is different. The breakout that already happened and the reversal is completely different than back here. We never got that bottom side breakout. We only had the top side breakout that continued the run. This is a little bit like an evening star reversal too. So that should be a bit of a pause. It's a weekly evening star, and that's harder. But you see how it closed here and it gapped up here and then it fell. That's a bit of an evening star reversal. It would have been better for a short, looking at this and saying, "Oh, it's an evening star reversal." We would have wanted it to fall all the way down and close lower than that bar. And then it would have been a really good evening star reversal. That would have just been a fantastic short, but we didn't have that. So for right now, you could argue that your trade hasn't lost yet simply because we don't have this low in. And so we don't know where the if the trade is a loser or not. Now, see that's a good approach, right? I know a lot of people who trade things this way. It's very orderly and it's very systematic. So this selling anything crossing down through the daily 1020 as measured moves are complete. The bull run may be over until it hits the demand zones and then back to the triple again, right? A very clear path with clear rules. And I am in no way suggesting that you have to follow this person's rules. It's the idea that they have a plan and they know exactly what they want to see. There was a book by Gerald Appel that I thought did a really good job of helping people lay out a plan. The book though was more about evaluating where treasuries and commodities and the Fed is at, and then looking at the S&P and the Nasdaq to determine is right now a good time to be looking for trades in any, in equities based on those things. I've shared that book before, but I'm going to share it again. Gerald Appel is the guy who is attributed with the MACD. And I say that because we will never know for sure if he is the actual guy that made the MACD. I've heard some arguments. All right, here's the book. It's just called Technical Analysis, and it's by Gerald Appel. It's an older book, and he talks about building out indicators on there that nowadays we don't even have to build, right? Because they already exist. But back in the day, you had to put work together any way that you could put it together. All right, it's gonna get loud for a minute. Maybe the dog is gonna bark a little, um, but she'll calm down quick enough. So if I mute you guys for a minute, you'll know why, right? Like I didn't accidentally hit the mute button, and I'm not sitting here talking to myself. It'll just be I'm trying to save you from having the dog bark in your ears. So it's a good time to get a soda, or grab a piece of that triple chocolate cake with the chocolate syrup and the chocolate fondue and chocolate chips and peanut butter. Who knows? Maybe she'll be good and she won't actually bark. That's a laugh. So one of the reasons that I try to do themes is because the other markets are a tell. Let's go back to Rocket for a moment. I know Rocket as opposed to Chewy. I mean, I've traded Chewy and I've heard of Chewy. I'm just not comfortable with Chewy. I don't know its peer groups. I don't know who its CEO is. There's just so much I don't know about Chewy. But Rocket, man, I think Rocket, and instantly I think Open and Redfin and bonds and treasuries. Yeah, always have you got to always have the goodies, with the grandbabies. We bought that 3 pounds of licorice but it's the red vine licorice, and well, they didn't get any. That thing ended up on my desk, and then I don't know what happened. Just goblins or gremlins or something. Yeah, I forgot. I don't know what happened. Maybe it got left at the store. We never made it into the cart. Yeah, that's what happened. So when you have other markets that you can compare the market that you want to trade, it really helps. And it's one of the reasons that I like trading banks, why I like the Mag 7. So, themes, pot stocks, gold. I was sitting here the other day trying to remember when I ran that live stream where we talked about gold. And I was explaining how we were getting into this phase where even the worst gold mine companies in the world were going to get bought. The cheapest, trashiest junk companies that nobody would ever look at was going to get bid up, and that it was going to become very exuberant, and that it was still a beautiful long with plenty of room left. It's been a while. It's been at least a year since we had that conversation. At least it feels like it to me, but I could be wrong. It could have been January or February when we were talking about that, but it sure has worked out really well. And the crazy thing is, it's not done yet. It's still not done yet. But the good thing is that we were able to see it coming, right? And that there was a history, a precedent that said we were getting into the conditions where gold is just going to go and go and go and go, and it's not going to stop anytime soon. There's a ratio chart that I like to use for this. I just got to dig it up. It doesn't have the typical gold like you would think. It's an AXU, and darn it, I got to dig it up because it's not showing up here. Wait, maybe this one. No, it's gold and S&P, which is still a good one. See how we're not even at resistance? We hit resistance, which is where we pulled back, and gold had that pretty decent pullback, but we're still we got plenty of room to get back up to that previous resistance. I'll get the chart. Just a second. There it is. Nope, that's GLDSPY, same one I got. Where's the other one? Ten-year note. There it is. Okay, so the chart, and I probably have it. I just didn't want to get buried looking for it. It's XAU USD, and then multiply XAG USD. Put that in parentheses, add the caret, 0.5, let it run. No, why you don't like it? What did I screw up? Oh, I put a Z there. It's XAU USD. There you go. That's the one. Make the charts match. All right, this has been a beast. First, this is a 3-month chart, so breathe, because that's a lot. But see that U shape, and just coming into 2025 was this pullback. Actually, that's yeah, that's January 2025. There's the pullback, and then away we went. That's a 3-month. Every candle is 3 months. Now here's the 1 month, and it looks like a rocket ship, right? So then you get into the weekly, and then you get into the daily. Now we can argue that this is getting parabolic. It's not even getting the healthy pullbacks that it's supposed to have, that markets are supposed to have. It doesn't even have that anymore. It just it's just going straight up now. And when it starts to do that, you know you're getting close to the point where it's going to turn around and come back. It has gone parabolic. The problem is trying to time that reversal can be really difficult. We don't know when this is going to end. It had the 5 bar rule, then it paused, and now it's going again. One single pause in the whole thing. And what we're looking at here, by the way, is a gold silver ratio, right? That's the ratio that we're looking at. And it's crazy wild. Look at that breakout from 2024 with a Busby, lots of consolidation into 2025, and then it just took off. So there's no argument that we're going to get a pullback because it has to eventually. Price will pull back, but that pullback doesn't mean that it's done. And a lot of analysts are saying, no, it's not done. No, heck no. There's a lot more room to go here. If China does get away with becoming the world's gold reserve location, what's that going to do to the dollar? And I don't know, but so it's a really good ratio. I don't think you can have it on Think or Swim. You could try, but start with each one individually. Try the XAU USD, see if it has that, and then the XAG USD. And if it has both of those, then you should be able to do the math. Only instead of the caret here, use a backslash on Thinkorswim because the caret here is just saying divide these two. I believe that's what it's saying. No, it's not what it's saying. Yeah, the VIX. The VIX is a tricky little booger. I've got a number of VIX charts. Let's go to the top of my volatility list. All right, so with the VIX, we've got that historic average at 1929. And if we get above that and close above it, then um, those VC funds will have to start liquidating. As long as we're below it, then they can't, right? They're not allowed to be discretionary traders and make decisions about when they want to get in and when they want to get out. They have to follow the rules, their rules, right? So the volatility control, that's VC, volatility control. The VC funds will stay long as we're within those boundaries. Now, places like Spot Gamma and Trady Ticks and Minthor Q, all those guys are talking about how we're starting to see trader bets and increased positioning in the VIX. But that's not necessarily what we think it is. And we can gauge that sort of behavior within the VIX models. What you looking for, babies? Yeah, I love it when that happens. So we just looked at the VIX levels. Now we can look at the VIX variance. Now, variance is the relationship between historic volatility or actual volatility and implied volatility, right? Remember, implied is promised, historic is real. It's what we actually have versus what the market believes we're going to be getting or believes what we should be having. And variance or historic volatility, it's still pointed down. It didn't get the bounce that we saw here in the VIX, and it's not getting this bounce that we're seeing in the VIX. But this is a 5 minute chart. Let's get off of that and kind of go out here a little. We've got higher highs and higher lows in the VIX, but in variance, we've just got this high here, and this is unresolved. Now, how much volatility is in the volatility indicator right now? How much volatility does VIX have? I love this chart. I use it all the time. If we start to sell off, this is one of the first charts that I go and look at to try to gauge what the traders are doing. Are they positioning for more in this sell off? Or are they just taking a little bit? Hey, have a good weekend. So the lines in the sand, this red one and this green one, the way I read this is when we're coming out from below the green, that's a really good time to go long in the Mag 7 complex. If we are coming down through the red, that's a time to be getting out of the Mag 7 complex and or getting short in them. You don't have to short because it could end up just doing something like this where it doesn't actually go down, but it's not good longs. But you don't want to be trying to open new swing longs in the Mag 7 if we broke 1.18 and we're headed to the downside. And if you look, that's what we have right now. That's the market conditions that we have. So, you know, obviously we can turn around and we can go back up. And if you had caught something like that, it might have been a good long in the Mag 7 group, or maybe on that one, it might have been a good long, right? Maybe. I'm not saying yes, just while it's still falling and it's below that red line, you don't want to be hunting for new longs in the Mag 7. Those are those red light, green light conditions, right? Like this is telling me it's a red light environment that I don't want to be looking for new long trades in the Mag 7. I did. Yeah, they're hand drawn. It's not an indicator. The ratio is VIX3M divided by VIX. And that one you can do on Thinkorswim. You might have to use the indicator for ratios. What, you can't find VIX3M? I call BS. Yeah, there's 3M. So what's the issue? And there's VIX. Yeah, we might have to use the ratio indicator. That's okay. We can use the ratio. So just set this one to the SPX, bring up the beaker, and you want to type in the word ratio. Preferably price ratio, but there's a pair ratio too. Price works. Notice it's set to SPY and gold. So just open it up and then swap it out. VIX 3M and then VIX. Make sure you hit enter on that so that it actually sets. Otherwise, you come down here and you hit OK and nothing changed. I want to use the exponential moving average. The averages that it's adding is here's the ratio, and then it's going to give us a fast and a slow. So I want my fast one to be 10, my slow one to be 20. I like my 10 to be blue, 20 is green. The indicator, I just want one color. I don't like that uh, up down color stuff. Just makes it sloppy and hard to read. All right. So there's the same indicator that I'm looking at on TradingView, only we're not on TradingView. Then we just remove price action from the top of the screen, and ta-da, we got a full size chart of that ratio, and we got some moving averages. We don't need the moving averages. We can turn those off, but it's nice to have them, I guess. Can't remember where my other line is at. 2. So yeah, it's been a hectic day. 2 and 18. The other lines are 1 and 1.2, but these two are the important numbers. And you could color code them, right? Red and green, like I did on the other one. That's just putting lipstick on a pig. That told me that this chart has things that it doesn't have. That's crazy. Um, Comes from analysis of price action, right? So a long time ago, I'm going to do that on TradingView because it'll just be easier. A long time ago, I did work where first you make the ratio and then you try to compare it with Thinkorswim, right? Use this one. In the bottom, we're going to put Thinkorswim on, not Thinkorswim, S&P. So on the bottom here, we'll put S&P. On the top, we'll have that indicator, and you can do it either way, vice versa. It doesn't matter. But you want to look at what did price do when this indicator, broke down, and what did price do when the indicator went up, and you're just running that sort of analysis. In the last 2 years, these really big drops broke the indicator, but if I was to go back before that, it's really clear. Like you guys are only seeing it from where it is now, and the lines don't make any sense, right? Because I can't even argue with you. These lines now look really weird. Like, well, where did you get those lines? But if you was to go back before all the violence, back here, when things behaved more rationally, those lines line up really well with price action. Now we just got to get this. to change to the signal that we want. Oh, I still have it set for matching symbols. No, I don't. It should let me swap it. Yeah, there we go. I didn't have to do anything else. Just match the time, date range. That way, if we zoom in or out, it should match. There it goes. So back here, when things were more normal, we were able to do a comparative analysis, and that's where those lines came from. It's not a perfect science, right? It's just swag levels, scientific wild ass guess, SWAG, and try to quantify at what point does that reversal have value or merit and will impact things like the Mag 7. But in the last 2 years, we've had these crazy moves, right? This is the tariff capitulation. It got really wild there. And I think one of these two was Japan with the carry trade unwind. There was the Jackson Hole Powell moment. I believe there was. I thought there was back here somewhere. I think it was that really violent move because we were all coming into that 200 day and we were having that breakover and it was a inverse head and shoulders. Everybody was looking up and then Powell was like, "Suck it up, kids. We're staying higher for longer," and boom, down it went. So now that I've zoomed out, you can see the more of a quiet period. All right, if you haven't heard it before, there's something called SDEX, right? Which you got skew, you got SDEX. The definition, I went and copied it a long time ago and I just leave it here. The nation's skew dex, which is SDEX, is an index that measures the skewness or tail risk of the market. Now, if you think about it, skew is skew, right? This is measuring that skew. It's evaluating that skew, trying to anticipate the likelihood of extreme price movements, crashes, or spikes within the S&P or related equities. This is distinct from the VIX or the VVIX, which is volatility of the VIX, and it's focusing on the asymmetry of option implied volatility. Skew is a reflection of volatility within the options chain, how traders are trading, not what they're saying they're doing, but what they physically are buying and selling. And of course, those are forward looking because they're putting trades on with the anticipation that price is going to behave in a particular way. It's one of the few forward looking indicators that we have, volatility. So if we have right side skew or left side skew, right side tail risk, left side tail risk, this is measuring that skew and giving us an indication of what is going on. If we was to overlay this with something like SPY or SPX, either one, see that really high skew SDEX print matches that April low. There was a lot of fear and a lot of uncertainty, just like there was down here with that really high print. Or even at the highs, which, sometimes we argue just because we're at the highs doesn't mean we can't get volatility. Even when we're at the highs, we started to rise up in this SDEX before price broke down. We didn't actually start breaking down until this this point right here, and we were already at 60 at that point. So the SDEX broke this previous high and started to break out on the day that we began to break down in the S&P, and it spiked from 60 to almost 70 because traders ran out and tried to hurry up and get protection real fast because the market was sitting at the highs. Christmas, they were worried. New Year, it freaked them out, but the freak out didn't last for very long, and then we unwound it again. The next drop, they weren't as scared as they were the first time. So we can come in and look, we can look at the skew, the SDEX, and say, well, where's the skew at? It's above 60. It's still really elevated, but we're not seeing big, violent sweeps to the upside. Now, you can treat this skew indicator, this SDEX, just like you can treat price action. So you can measure trend lines, measured moves, ranges, breakouts, breakovers, resistance, support. You can do all of that within this too. And we're getting a breakover, it sure looks like, anyways. I don't think that's fair. I think that's fair. It's not that they should move together or opposite, it's that we should understand what this is telling us. If traders run in and trade a bunch of puts, say they get scared all of a sudden and they just run in and start buying a bunch of puts, this thing is going to shoot up really high. Well, typically, if people are running in and buying a bunch of puts, it's because we are falling, right? And that makes sense. We're at the lows and new traders are scared and they think we're going to go lower and we're buying a bunch of puts way down here and the SDEX spikes. But it can happen at the highs simply because institutions are looking at the highs and saying, oh no, we got something really big coming. Let's load up on some puts just in case. Well, then you still get a lot of put buying, but you don't necessarily get the fall because we didn't actually have something happen. They just thought we had the potential for something to happen. And they went out and bought a bunch of puts on that potential, but then nothing happened. So then you get the spike, nothing happens, the spike fades. So it's not that they are supposed to move in sync or in tandem or opposite of each other. It's just the idea that if this spikes, it's telling you they have just loaded up on a bunch of puts. Well, what the heck are they doing? So we want to go look. Why are they buying a bunch of puts? Is the market crashing and burning and they're trying to cover their butt? Or do they think the market is getting ready to crash and burn and they're preparing for it so that they can make some money? See, so it just helps us better try to gauge what's going on out there. And it's a warning, hey, they're buying a bunch of puts because that's where skew comes from, right? Way back in the day, before the 1989 stock market flash crash, calls and puts had the same price so that they were equally balanced. If you were one strike out of the money on the calls, the price that you saw there would be equal to one strike out of the money on the puts. Everything was equally priced and equally balanced. They weren't pricing in risk. After the 1989 crash, a bunch of scientists got together and argued the case that trader participation should highlight that risk. Well, what are we scared of when it comes to the market? We're scared of it going down. And because of that, puts are usually traded more than calls on the buy side. People generally buy more puts and they generally sell more calls. That dynamic has changed over the years, by the way. And Volland has this really great write up about how that dynamic is just not true anymore. But back in the day, that That's where the logic comes from. So when you're looking at options on Apple, Microsoft, whatever, and you notice that the puts are more expensive, that's because there's left side tail risk. We have a fear that the market is going to fall, and they are trading puts, buying puts. And as usual, if you buy a lot of something, then price goes up, right? If I'm competing with somebody else and we're both haggling to buy this thing, price is going to go up. That's typical skew, and that's what we expect out of markets. Where it gets screwy is, what if it's oil? Well, we don't care if oil goes up, right? Do we? Do we care if it goes down? So it's the other way around. In oil, spikes high is really bad. You get oil that's too expensive and you can just break the world. Everything would shut down. So when it comes to commodities like oil, the skew is actually on the call side and puts are cheaper. It's the same thing with VIX. VIX is a reflection of the market going down. So in the VIX, we expect people to buy calls. If they're scared of a market falling, calls should be more expensive than puts. I mean, look at this skew right now. One out of the money strike, 17. This thing is running at $4 and 60 something cents. One strike out of the money on the put side, it's not even a dollar. It's not even 75 cents. Big skew there. And we can chart that skew and see the smirk or the volatility smile. So we're in the VIX. We could look at the implied vol. Let's look at pricing. Bring that skew out. Oh, come on. Let's see it in SPY first, then, I guess. Where's my head at today? All right, there it is. So this is what our typical skew would look like, and that's too many things. So we'll just knock it down to like one. Not that one though. Something that has a real smile to it. Give me a smile. There we go. There's a little bit of a smile, and we can gauge that curve. The other way that we would draw it would be in here, where you have there it is, the width of this thing and the midpoint. If there's right side tail risk, then the curve will show. This would be right side tail risk, where it extends much farther this way than that one does. And if it's left side risk, it'll be the other way around. So where it extends a lot more this way and less that way. Left side tail risk. The volatility just keeps going before you finally get to zero. Some platforms show it really well and others don't do such a good job. Shoot, guys, we didn't roll that Intel trade or try to roll. I'm going to log out and get that done real quick. Remember, we're not actually going to roll the Intel one. We're just going to attempt to roll it, but we will roll one of the others. It doesn't even matter which one, the Google one or Microsoft, Amazon. I think we had a few on there. Almost forgot. So with this SDEX, what it's doing is it's trying to analyze the skew and see, hey, are they running out and buying a bunch of puts? And then we have to make the extra leg work to try to figure out, well, why are they buying a bunch of puts? Are we crashing and burning and they're freaking out? Or do they think we're going to crash and burn and they're trying to prepare for the fall? All right, this is Google, and we have a call on. So we're going to right click, create rolling order, and it says 383 debit. And where did it roll us to? February in the same strike. Well, how has the trade done otherwise? Is this call profitable? Is it unprofitable? Where are we at in the trade? We bought it at 1920. It's currently trading at 1897, so we're down a little bit. If we wanted to roll it, let's stay in the same expiration and let's see if we roll up. Yeah, they'll give us a credit if we roll up. 240 in credit. Why? We're rolling to the 250, and the 250 cost $16 and 60 cents. Let's try to find the mid there between those two. Our option, we paid 1920. So they're looking to sell our trade back to the market for 1902 or $19. So we'll lose 20 cents on that and then buy a new call out all at the same time for this split here between, call it $19. Let's stop that roll for a moment. Just right click, sell. Right. If this was the Intel trade or a trade that we wanted to keep, yes. But all we want to do, the reason I added a couple of the extra ones is just so that you guys can see the math behind the trade. We don't care if it's a good position, bad position, a thoughtful roll, a strategic roll. We don't care. We just want to look at the math behind it so that when you go to roll a trade and it shows you some number down there, credit of this, debit of that, you'll understand where the hell did that number come from? And is that a good number for you? Is it going to help you? Or is it a bad number for you and it's going to hurt you? So if we was to try to close this trade right now at $18.80, when we bought it, we paid $19.20. This is a losing trade. We would lose money. Looks like we would lose about 60 cents. So why in the roll are they giving us a credit of 250? That's what we want to demonstrate here. So wrong button. Let's go to the roll. And man, I should have done this earlier. And sure, let's go ahead and kick it out down the road. Let's run it to March and we'll kick it up to 260. They're offering $1 credit for that roll. And we're just going to do it because, hey, it says a credit. Why not? Right? We won't even argue with the positioning of it. Boom, we got filled. What is our new position? Since they gave us $1 in credit for this roll, which is a little odd. We had to pay for volatility, we had to pay for time, and our trade was losing. So how did we get $1 of risk out of this trade? Well, this new option is worth $18 and our original one was worth $19. So now we're holding a long call for 17.90 after rolling the trade for $1.05 in credit. We sold the one that we were holding for 18.95 and we bought the new one for 17.90. Subtract those two, and you get your $1.05. So now our long call is a March call, and our average trade price is 17.92. What is it trading for if any other Joe Schmo was to go buy it right now today? 17.92, right? If I just go in here and try to buy one, 17.95, 17.92. So that's Thinkorswim's way of doing the roll. It applied that dollar, and I would say this isn't the way that it used to work, right? When I was trading over here, that was not the way that it worked. But maybe they changed it, or maybe again, maybe it's because of paper. But that's one example. We just did it. We saw where the dollar came from, and we saw what our new position is. So let's do another one that's on this list, as long as it's not the Intel trade. The other one we had was Meta. We're out of time. Shoot. We've got um, looks like quite a few of those. Oh yeah, we got verticals over there. We were going to roll the verticals. Either way, we got the Google one done. When you go to roll your trade, it's going to show you a number. And this is the point I was trying to make with these extra trades, because we don't care about these. We only care about the Intel one. If you go in and you try to roll it, it's going to give you a number down at the bottom. And you have to be able to understand, hey, what the hell is that number? Where did it come from? And what is it doing to my trade? So now, if I try to roll this thing from March to April and I go out to 270, imagine that. They're giving me a credit. But what if I wanted to roll it closer? Because remember, I'm holding a long trade. I don't want some long trade that's way, way out of the money. What if we try to go to 250? Well, now they want me to pay a debit. And if I did that, well, what would my new position be? Well, they would take this debit and apply it to the $18 that I spent on this one. $17 and whatever, 17.90. Let's just call it $18. I'd be holding a long call for 18 plus 6, $24. What is the 250 strike trading for? $22.50. So my call would have a lot more risk than that. I could just buy a call for 22.40. If I did this roll, I'd have it for 24. $2 extra of risk. This is not a good trade, right? It's pricing, it's giving me $2 extra of risk that I wouldn't want to take. Plus, it's a debit. You never want to roll for a debit, ever. So all I was trying to show is, where did this number come from, and what will it do to the trade that I was currently holding? What will my new trade be? Every broker shows you this in a different way. And you have to know what your broker is showing you. Most of the time, the only way you're going to figure that out is to just actually go in and roll it. So, what I recommend is record the whole thing and do it slowly so that all the numbers are showing and you can clearly see what you have. And then you can go back and you can watch it over and over again, try to figure out what the numbers did to your position. And if you still can't get it, ask me, because you already recorded it. I'll be able to watch it and I'll be able to figure out what it was. Right now, for that Intel trade, it is too late. And what I wanted to do, I didn't want to actually roll it, but I wanted to price a roll, right? That we go in and we look at the Intel trade and we say, okay, how much did we pay for it? What's the value of it right now? And if I tried to roll it, how much money would they give us for it? Because that's what you want to be doing to the trades that you are holding. It's really hard to try to know if the trade you're about to roll is a good roll if you've never tried to roll it before. Because how do you know what fair value is? Or how do you know if today's roll is any better than what it was yesterday? You want to price it often. but it doesn't do any good to try to price it if the number that you see doesn't make any sense to you, which is why we put on a couple of these other ones just for extras so that we could roll them without caring what we ended up getting. Yeah, see that one's also a debit, and we're just rolling out to the same strike. And oh, by the way, that question about going out into a different strike or a different expiration, you don't have to do that. On my trade on the Intel trade that I rolled, I stayed in the same expiration. I went from 30 to 40 and I didn't change the date. So you can change the date, right? Hey, Hugo, you have a good weekend. I appreciate you showing up. Um, be careful, stay safe. I'm kind of scared to even look at what my backyard is right now. I bet it's just completely destroyed. They took down part of my fence to get the heavy equipment into the backyard, and then they didn't have any wire to put the links back together, so they just tied it with some rope. Oh my goodness, what a mess! All right, so here's my Intel trade, and if we look at the dates, and I'm pretty sure that's really hard to see, so we'll just take a picture of it so I can zoom. I stayed in the same expiration. I just moved from the 30 strike to the 40 strike because it still has 105 days. There was no reason to extend the life of the trade. All I wanted to do was get risk out. And there were, to get risk out, I didn't need to add more life. So we took our 30 strike and rolled it to a 40 strike. And we got $4 in credit for doing that. And if you subtract $1.50 from $4, you end up with a net bare minimum profit of 250, which is what the current trade has. It's a long call held as a credit with 250. So sometimes when we roll, we're trying to adjust our position. We want to get above a particular level. We want to go farther out in time or closer in. And we call that strategic positioning, right? Like we're just trying to move our line in the sand. But other times when we go to roll, we're just trying to get risk out, which is what the Intel roll was all about. I just wanted to take away some of the threat that I had. And so I rolled it without really changing anything in the time space. So next week, when we start, we're going to start with the roll. That way we don't run out of time like we did this week. And then we'll go into whatever topics you guys have, which, by the way, I always love the topic requests. If you guys have a topic that you want to go into, by all means, let's do that. You can send me messages through a DM, or you can just throw them in the chat. It would give other people maybe some ideas if you are using the chat, but either way is fine. And we can talk shop on anything, right? Swing, trade, day trade, stocks, options, futures. It doesn't matter. Indicators, price action, chart analysis, volatility, whatever you guys want to do. It is Friday though. It's after 4. So if you guys don't have any questions, I'd say let's wrap it up and get the weekend started. No questions? All right, guys. Then that's it. Be careful, be safe. I'll see y'all on Monday.